Welcome, ladies and gentlemen. My name is Dustin Kircher. I got my partner here, Ben Dreicer, and we're part of MHP Nation. Glad to be back on the show. I know it's been a while since we've done a show. We've been busy on a couple projects, and a lot of traveling back and forth has stopped us from doing a show. But, anyways, we are back with an exciting one, and we got an amazing guest, James Cook. He's the founder and of the brokerage of Yale Realty and Capital Advisors. So he's got some definitely a background in this business. He's been in the manufactured home communities for over 2 decades, and he's done $1 billion in sales and in financing. So we're happy to have James on the show and share and discuss his experience and see what he has going on in this space. So James, thanks for being on the show.
Guys, yeah, appreciate you having me. It's always fun to carve out some time and talk with guys about the industry and catch up because we all kind of get busy with our little worlds. And this is a nice break. It could would break the monotony up of deals sometimes. But yeah, appreciate you having me.
Yeah, thank you. So tell us a little bit more about yourself, James. And I know I said you've been in this business for about 2 decades. Tell us how you got started and what you're doing now.
Fun. Yeah, appreciate it. Yeah, I discovered manufactured housing at the ripe old age of like 18. I got my real estate license.
Nice.
Um, so yeah, a little over 2 decades ago, at 18 years old, got my real estate license, and my best friend's dad was a broker, and he was a developer in our hometown in North Florida. My family moved there when I was a kid from Chicago, and so was prospecting. Ran across this guy who had a nice sized manufactured home community in hindsight. And my broker was convinced it should get turned into a multifamily project because it was in town. And I was sitting there. I remember talking to the owner, and I'm like, "Why would you clear out this cash flow?" That was kind of something that dawned on me even back then. I'm like, "This is a great business. Why would you get rid of these people?" And I understood his argument was, "Hey, he's a big local owner, and he wanted to pretty up the local community." It was definitely an older manufactured home park, aka trailer
Mhm.
park. Um, and it was a truly an old-fashioned trailer park. And so I realized at that point, hadn't studied investment long enough to know the term asymmetric investment, but I realized that these were essentially asymmetric. We had a great cash flow, and then if everything went well, you could potentially end up with a higher and better use. So kept doing residential and was helping run a family service business for a few years. Took some other little listings in parks and realized there was a little bit of a niche demand for this industry, and everybody had a little different criteria. As I talked to different buyers, one would want a bigger property, one would want some RV, and one would want no RV, different regions. So I jumped in full time at 21 and decided to focus strictly in this industry. Um, and there was a lot of like regional brokers or specialists, but there weren't a lot of big national brands and teams fully dedicated to the space at the time. And maybe it was the infancy of the industry, I think, from a more institutional standpoint. But yeah, that's kind of the genesis of it. I don't, I guess fast forward, I moved down to Miami in 2015 or 2012. Met Chris San Jose. He was a pretty, fresh graduate from Florida State with a real estate and finance background. Hired him as my new underwriter. I just lost an underwriter or just let go of an underwriter. Hired him as my new underwriter. A few months in, we started getting some inbound demand for loans. And I had been previously, during the great financial crisis, 28, to 2014, 15, debt was pretty scarce. So I was kind of putting together the financing for deals as we were selling them almost as just a service to get the deal done. And 2012, Chris comes on. I said, "Hey, we got this demand for loans. We have clients buying things from me. We have clients refinancing. Can you focus on that?" So he went out and built out a great financing business under Yale Capital Advisors. Today, I think it does roughly half our business. So we're at nearly $9 billion in closed transactions, on 140,000 spaces closed across the country. And Chris has built
Wow.
out a really good reputation in the financing side. And then we've got a national brokerage team that sells communities from Florida to Alaska. Essentially, got a regional around the country. You guys are out in California. We just closed a couple deals in Northern California, a little north of SAC. We got some deals. We're negotiating a pretty large deal up in Washington State right now. So, great exposure over there and just closed a bunch of stuff on the East Coast, Pennsylvania, $48 million deal in a package, and then pretty nice size deal in Kentucky. I just closed a $37 million deal in Florida. So yeah, we're a national firm doing deals all between, in all the flyover states as well.
Hmm. Nice. Very cool. And on the brokerage side, how are you guys, you guys are national. Um, how are you guys finding your deals? I'm guessing you're just talking to a lot of sellers, nationwide then.
Yeah, I think that's it. I mean, I think you've just got to, I believe in having somebody who's local and knows the market, and local in this industry means you cover 4 states or 5 states sometimes.
Hmm.
But we got a New England guy who lives up there in that market, and we got a Mid-Atlantic guy. We got a couple of Midwest, we got Midwest East, Midwest West, got a West Coast team. And then those folks are, they're doing everything from, calling these owners to emailing these owners to mailing these owners to showing up at their properties to being part of, the community. They're involved in. I've got folks who are on the association boards and are helping fight different, negative regulations that are coming against our industry or coming after our industry. So we're involved in the associations. We're involved, in the industry from a lot of different sides. And the way I see it is, I'm invested in this industry deeply. I've got, a vast majority of my net worth is in this industry. So whether we, we're financing communities every day. We have a relatively new equity division. We've launched the equity division, I think 21 or 22. So we're doing investment banking now for the industry, putting together basically marriages of, guys like you that are on maybe their 10th park and are tired of passing the hat. Friends and family want a programmatic equity partner. So we're talking to your Wall Street funds and your pension funds and your life cos and all those groups who want to be investing in operators all the time. We're doing half a billion dollars a year of financing, and then we're selling about $500 million a year. So, we're at this point we're one of the brands you're going to run across in this business if you're in it for any time. And I think from a boutique standpoint, we were the first to kind of merge brokerage and financing, and then we're the first to merge brokerage financing and equity into one platform service, and kind of pioneered that you know uh, full in-house vertically integrated platform. And it's again live and breathe this business. So hopefully we're helping people because they know us and we've helped them with something other than just a sale or financing. We may have helped them with with in new, whether it's rent studies or whether it's doing some um, you know just studies on whether there's a feasibility for a new property that makes sense to develop. There's a lot of different opportunities we're having to interact with these people long before they sell, long before they refinance, to add value to their lives, and then hopefully they'll choose to work with us when the time's right.
Yes. Yeah, I mean, it's a great platform to have where you can offer a park for sale and package it with the financing, right? Um, yeah, I'm guessing when you're talking to sellers, are you you're giving them insight on where the pricing should be based on what financing is going to look like, right? Because if you can't get financing, then there's no point of purchasing that. I mean, it makes it harder to purchase that park for sure.
Yeah, yeah. I mean, our typical deal size, I think, is about, historically has been 8 million, 9 million, maybe even above that right now. So there's a whole range. I mean, you see deals today that are selling to core investors, life insurance companies, pension funds that really don't make sense levered. They're just basically, we've talked to groups in the last 30 days that are targeting a 7 IRR over a 5-year hold. And you
Wow.
guys would wonder, you guys wouldn't get out of bed for that, right? Um, so
I'd be
that's the
scared
beauty
scared of that.
of capitalism. Unfortunately, we've all invested in those deals, right? We just didn't mean to. Um, we've all done those deals. Um, but it's the beauty of capitalism. You have your aggregators, you have your guys that go in and fix up stuff, and then there's a reward waiting for those who clean it up, make it nice, and make it, and can assemble a nice enough portfolio where they get a really nice exit to a core capital, investor. You've got your
Mhm.
value add, you get your core plus, and you get your core money and different buckets and different investors looking for different hold strategies, or different return, profiles. So yeah, financing is a big part of it. Today I think Chris San Jose runs that desk, and obviously I hear about it a lot, but we're seeing a lot of people that are buying stuff with kind of bridge financing where they're saying, hey, we've got to lease up these 300 sites. and we're going to take the rents to market over the next 4 years, and we're going to pull these different levers, put millions back in the property, and then when we do all that, it's going to be worth a bunch more. And so they're using kind of bridge financing or unique balance sheet financing that some of the lenders might offer them just to get their eventual Fannie Mae Freddie Mac business. Or more business has been going, I think, conduit Wall Street lately. And then there's a whole world of balance sheet, banks in our business that love the industry and know it well. And I'm sure we know some
Yeah.
of those names, and hopefully we'll bring some names for you or any other borrower that you don't know off the top of your head. But yeah, that's one thing that we've talked about a lot internally is, you know, if you go to, you name it bank who has a license to go to Fannie or Freddie, you're just getting one source of debt. They're not really debt brokers. They're just offering you their platform. We're Switzerland in the fact that we can go to, any of the Dust lenders and they'll take our business gladly, but we can also offer you a suite of a bunch of different services. If you go call up, I don't want to pick on one because they're, I don't want to call any of them out, but a lot of them don't even have a balance sheet, so you're calling them, hey, we'd love to do your Fannie Mae business. If they are willing to give you a bridge loan, it's expensive because it's basically somebody else's money relabeled. Where some of them might have a bridge program that's super unique to our industry because they really want the Fannie Mae and Freddie Mac business. And then there's other times where the last couple of years where deals have made no sense for the agencies, it's really been made more sense for conduit and for proceeds. You can play the game with, rate buy down and stuff. So there's a lot of nuance to it. But yeah, we enjoy kind of having the full perspective. I know as a young broker, I didn't understand how much financing was the tail that wagged the dog. And now I think as a little more mature broker, I'm only in the business 20 years, but haven't done it full time for 20 years. The other thing you don't really realize is how much equity wags the dog. You used to get those calls from XYZ buyer and, oh, we got, 50 million, we got to spend 100 million, we got to spend, or whatever the number was. And now it's turned into, we got a $500 million commitment, we got $1 billion commitment. You hear these guys say that and you're sitting there
Yeah.
thinking, how are they going to put all that money to work? But let's do it. Sounds fun. Um, but now you understand, okay, well, where's that capital coming from? It's not how much capital you have, it's like what's their return profile. And we happen to know, I've sat down in all their Wall Street offices and know those groups and I know how they're looking at it. So I know when I talk to, one of these groups that you hear about that's buying, I know the psychology behind the money buying it and kind of how they look at it. Some of them don't want rural, some of them don't want treatment plants, some of them don't want any park-owned homes. They all have different, check boxes. And really, it's the equity and now the debt that wag the GP's tail, or the group that you see, the brand that's buying your property. It's usually there's a lot more driven by the equity in the debt than really that sponsor.
Which puts you guys are in such an advantageous position, and that's such a value add to everybody, the park owners, park buyers, essentially anybody watching this who needs the money can contact you guys. Plus, there's opportunities in hand as well too. It sounds like that you guys continually have on deck.
Yeah, no, it's funny. Like, we'll be a via deal and we'll go with another broker and then we'll end up financing it anyway. Like happens all the time. Or, we'll end up being the equity, we'll end up providing the equity for that group. Happens all the time. So yeah, I feel like there's very few deals in the industry we don't end up touching. And it's just there's obviously 4 or 5 different service providers that are in any region, but we'll end up having a nice slice of the pie that we end up either touching either debt, equity, or sale, and sometimes all of it, all of the above. Like we were under contract on a big deal last year. Client was buying the biggest deal yet, and their equity pulled out last minute. Good execution for the seller. Seller's very happy. Ran a process, got them the best buyer. Equity pulls out very last minute. And so I think 20 days before closing, we called Jake Levin, our head of equity, and he did a fire drill and found them the equity. I think they might have needed to extend a week, but kept that $40+ million deal together. Seller's extremely happy using us on future assignments, and just created that kind of smooth experience where, yeah, when I was a 25-year-old broker, 15 years ago, if that guy says my equity pulled out, I'm like, crap, my next buyer is $1 million lower. What am I going to do? The buyer's now probably non-refundable. They're upset. There's a big drama moment where, you're going to lose some money. You have to restart the process. So that it's nice to be able to look at it from all those angles. And it allows you sometimes to see around the corner whether somebody's setting themselves up for failure, whether they're not going to be able to get it done, or if they're leaving money on the table. It happens all the time. I just talked to a client of mine, or a big owner in the industry, found out they're negotiating a deal at 40 million. And back of the napkin math, I'm like, that thing's worth 42 all day long. I called a couple of the buyers in the market, and sure enough, they hadn't seen it, in over a year. Um, the rents were significantly lower, and we all agreed it was worth like 42. So, having the full perspective, 360 on the equity, the debt, and the brokerage world helps us get a little better insight into how exactly things
Yeah.
work together. And it's always changing. There's always new equity, which is I think what drives our business is, there's always guys like you guys out there buying stuff and making it better, and then your takeout buyers are constantly changing, and for the better. In most cases, over my whole career, it's just we've continued to attract better and better money. Um, I have the saying people have heard me say before. I mean, I could count on one hand the number of billion-dollar funds in the business in 2008. Today, it's over $100 billion funds that are trying to buy actively. I mean, I quit counting at 100. I used to keep like
Mm.
Yeah.
a special spreadsheet of just billion-dollar funds, and it was north of 100 4 years ago.
Wow.
Yeah. That's what we're seeing. Speaking of that, you talked about having a unique insight because of the different aspects of your business. What are you seeing right now in this industry? Like, I know I've discussed it with friends and between Ben and I, and I'm just curious of what you're seeing and what's the lifespan or the opportunity period in this field in this market.
It's one of those things where I've spent my whole career wondering if we run out of deals, and you know, we've went from I remember starting my career. This may blow your mind, but institutional used to be 250 spaces or greater. And
Hmm.
there are guys I talk to the old timers and they're like, yeah, I won't touch that little park. It's only 170 spaces. I'm thinking, yeah, you're out of touch. I mean, 170
Hmm.
spaces in most markets in the country is a beast today. Um, we're seeing institutional competition on 50 space parks in infill markets.
Yeah.
So I think that's continued to happen, and then it's kind of a slow release business. The beauty of this business is people don't want to sell these things until they need to. So they hold them for a generation or two or three, and whenever you reach that breaking point is when it sells. So the old saying in real estate was death, disease, and divorce, the three Ds. Um,
Mm.
Hmm.
this industry especially, like they don't want to get rid of their manufactured home community. It's a great investment, stable, but at some point you get too many cooks in the kitchen, or you get too many generations, and we could spend some time talking about the horror stories we've seen with families who let it go down to their grandkids and then just destroyed the whole family fighting over it.
Yeah.
So at some
Yep.
point, you need to either have a buyout, a fork in the road where part of the family buys out the other part of the family, or you have a sale. And generally the buyout leads to a sale because, I had two brothers that were, arguing that this one brother, we brought some offers at like 12 to 14 million on his asset. And then the other brother goes, well, it's only worth seven. I'm only paying you 3.5 for your half. And we're like, well, there's offers from 12 to 14, so it's clearly worth more than that. So after litigating for 3 years, the court agreed that the market in 2022 was 13 or 14 million. This was an RV park, which actually the value came down a little bit. So the brother refused to sell, tried screwing the brother over who wanted to sell, ended up having to buy out at the 2022 pricing in 2025.
Mm.
And after let's presume $250,000 of legals wasted, family will never talk to each other again. And
Yeah.
then he's overpaying for the value now because he missed that window of the COVID window with 4% interest rates. Um,
Yep.
so yeah, it's I think generally, the industry continues to um, basically become more popular, and so as it does, we see more money chasing, basically smaller deals. And there's a certain amount of 5 7 year holders, guys that got in with a 5 or 7 year fund that have to sell. So those are constantly turning over what I call mid-size aggregators. And then there's still some mom and pops that have held these things for 30, 40, 50 years, original development families, or they get groups who bought it back in the 70s or 80s that are selling them.
You're still
Yeah,
seeing a bunch of those. You're still seeing quite a few of like mom and pop owners.
I mean, it's definitely, I think it was 70% of the market before, now it's like 30, but it's still there.
Mm.
Yeah, and then it's more and more institutional sellers and more kind of resellers, aggregators that bought up a portfolio, and and are either, basically pruning stuff that they've decided they don't want to own. Maybe they bought a portfolio and they had some far-flung stuff in regions that they don't want to be in, or they've just decided this is not the state for me or this is not the market for me. It's all the above. But yeah, we're
Yeah.
definitely. Whereas my career started out with almost all mom and pops, I spent a lot more time today with resales from aggregators, and thankfully still get to deal with some mom and pops. I mean, the $38 million dealer, 37 I just closed, last month. It's the second sale I sold for that family. That's all they have. They listed two different deals with me over the last 4 years. Both of them were awesome executions, and unfortunately, I get to see them for dinner tomorrow night. They begged me to fly over, go to dinner with me. They want to take me out to dinner, which is so sweet. And they want my head of underwriting to fly in too. We'll have to fight over the bill at the end of the night, but it's the last time. I like what's the sad part about this business is I always tell people it's like it's always too late if you know you like a broker or not, or if you like
Yeah.
usually the mom and pop. I mean, it's their only asset, so they don't know what they don't know until it's too late. So that's why I always encourage when a client calls us to list something like, here's 10 guys, call them. Here's the 10 last deals I've done, call them, see what they think. Would they do it again? And that's the only way kind of you get that the benefit from that great service or that great result is just the reference. Because usually the mom and pops, it's a one-time sale, and then the big institutions, we've thankfully Son's been very trusted. Son's been done the business with us for like probably did my first deal with Son in 2007 or eight, and I've had the opportunity to resell some of their stuff. They've used us multiple times. We're in the middle of a big package disposition for one of the big operators right now, some of their RV properties. So we've
Nice.
got some nice repeat business from the big groups as well. But anyway, it's a combination. More specific questions on trends and stuff. Happy to answer those. Can you pinpoint where you'd like me to go?
Yeah, I was going to ask you, are you seeing more RV park transactions, or are you seeing more manufactured home community transactions? In my opinion, just looking, I'm seeing RV parks are just blown up. And I'm curious if you're seeing the same thing.
It's funny. I did a lot of RV park sales in Florida. I probably sold 20,000 spaces in just Florida. And I've done right in your backyard, sold one in Acton. Um, now I've got a good California guy. The ones we just sold up north, for my West Coast guy, I just sold like three. They were hybrid or pure RV in Northern Cal. They're harder to move today though. The heyday for RV, and we had a run from 2000, from ever since I got in the business, 2005 all the way through. It kind of just felt like they just kept going up, up, up all the way through. COVID hit, there's the first few months scare, and then it supercharged it. And then it feels like, and I think all the data, whether you ask KOA or whether you ask yourself, looking at your P&Ls, all the data will say we peaked demand in 2023. It was kind of level in 2023. 2021,
Mhm.
2022, those were great years. 2023 was fine. And then 2024, we kind of dropped off. And I think if you look at like a rolling stock RV, it fell off anywhere between 10 and 15, 20% in some cases, in 2024 and then 2025. So we had consecutive soft years, 2024, 2025. And 2026 has been a weird one where we felt like we were recovering and then oil got too expensive and people are tentative about it. So the truth is, if you look at the data, I think RV park sales are down like 80%. The volume is down 80% from 2023 to
Yep.
2025. Um, and I think it's the best buying opportunity I've seen in the RV business because a bunch of it, as you guys well know, is urban infill affordable housing, and it's just not going
Yeah.
anywhere. Um, Transient though is definitely it's taking longer to sell. The cap rates have moved a lot. I mean, again, you're borrowing at 4% and you're buying those things at like 6.5s. And today you're borrowing it. I just got a quote today in the mid sixes. I mean, mid sixes to low sevens is kind of where RV's landing for lending. So,
Mhm.
we went from 6.5 caps to 6.5 to 7% interest rates. So, and if there's ever a business that really the core investors are not looking at, it's RV. So RV is truly a business, it's an operating business. You have to buy it with a cash flow, or at least a plan to get it cash flowing. There's very
Mhm.
few, unless you're in a special market like Arizona or Utah. We were just valuing some stuff in out west and some of those markets where it's business friendly. It's red. People are looking for red states more than blue states today, and and there's a big growth story there. then people could buy that, kind of in, at the current interest rates or maybe even inside the interest rates a little bit if there's a story there. But in general, you want to buy RV at like 100 basis points above interest rates, if not more. So yeah, so long story short, or short story long, I think we're probably doing 90% mobile home, 10% RV. It probably used to be more like 30% RV, 70% MH before. Um, but we're seeing some green shoots. We're seeing some RV transactions happen. I think we just sold a just $17 million package in the Northeast. Like I said, we closed like three RV deals between late 2025 and early 2026 in California. Um, I've got a couple pending in Florida right now, but they're definitely, moving slower. RV's moving slower today.
It's
Oh,
interesting
interesting.
because, like Dustin said, at least from a social media perspective, and you see just people teaching and promoting RV and how it's such an easy business. Maybe not easy. Well, they are promoting how easy it is and how it can cash flow so easily, but the actual trends are running the opposite. And people are getting into, I think, the business, or they think they're getting into the business with unrealistic expectations of how difficult and how much operation. Like
Yeah.
we have one RV
Hospitality.
park, and it's just I don't want to say it's probably 10x the amount of work as a mobile home park, and it's just operations and reporting from A to Z, every aspect of it. It's a lot more difficult.
Yeah, and I'm an investor in these things. I have this saying, you can't deal these drugs for this long without trying them. So I I wouldn't be a good broker. I don't believe if I hadn't put some money in the business, put my money where my mouth is. So yeah, I'm in one small RV park. I own with a couple of guys, and client of ours, we sold a bunch of stuff for him. He bought a portfolio, and he's like, "Hey, the small one, it's too far from my home base. My son can't run it with the other one. Do you guys mind buying it off me? Give you a good deal on it." It was a fair deal. I got to say, my opinion is brokers, people don't call me to give away their properties. So I don't get steals. People always have this perception that I get these bargains. No, they generally call me when they want to get, a good price for the property. So, we paid a fair price for it. I'm not beating the guy down. He's a good client of mine, good friend of mine. Traveled with him and his family and lovely guy. So we bought it at retail in 2022 or 2023. We spent,
Mm.
you know, 30% of our entire basis reinvested in the property and expanded it, reinvested in all the amenities, and the income's flat now. And we're 30% deeper in. We bought it at what would be way too low of a cap rate back then, which is way too low of a cap rate today. So we bought it at a fair cap rate then, maybe a seven, and now we have a higher basis. We're probably down to a five or six cap in the thing. I would much rather be in an MHC deal at the same cap rate, no doubt about it. And I fear that some of this, the promotion of RVs, um, a lot of it is either hype or it's folks that are raising a lot of money maybe to get themselves out of bad deals to buy new deals, kind of trying to dollar cost for average into better deals now. Um, we're in a good buying window now, but there's no doubt about it. It's a very different operating business. Um, you can buy one that the tenants tend to stay for a year or 9 months, and so it's a little more sticky, but it'll never be as predictable as a manufactured home community. The
Hmm.
basis, the discount for MH to RV, you should probably have a 300 basis point spread difference between your cap rate for MH and your cap rate for RV. It probably should be starting at about a 300 basis point difference. And half of
That's
that is
yeah.
interest rate. Think about this. I mean, MH you're borrowing still in the fives, mid fives, interest only, you know, non-recourse for good assets. And RV you're borrowing at like seven. So half of
Yeah.
that 300 basis point difference is just interest rate. Never mind non-recourse versus recourse in most cases. You can get some non-recourse from Wall Street on RV, but it's more selective. You get better interest only money, and again, then you get to work the difference in management, like you were saying, Ben. It's a much different profile to manage. So yeah, I think you're spot on. Talk to the investors who've put money in some of these highly promoted groups, and they'll tell you that they're not getting their distributions either. So
Yeah. I don't know if you guys caught that too, but James brought up the point about the 300 basis points difference between RV parks and mobile home parks. But I'm glad to hear you say that because my background is underwriting, and that's what I focus on, and that's one of the metrics I use. There's really as kind of like just the back of the napkin type of rule. is that's the spread between a manufactured home community and an RV park. So just because of the risks involved in the RV park side, it's a hospitality business, and so uh, there's more risk to it.
Yeah, no, exactly. I mean, it, what's funny is, again, I was selling these things all through the great financial crisis. And so the numbers kept going up methodically. I mean, it was like, you got the print on the 2008 numbers. They were up over seven. No other business was up. Eight over, nine over eight was still up. There's like 3, 4, 5% growth year over year over year. And so it was one of these businesses that was really sleepy, but we introduced a ton of new product during COVID. There's markets like Texas where people estimate they built several hundred new parks, flooded the market with supply. And, Florida, we had a lot of supply come out of North Florida. Arizona, there's a fair amount of new supply, but all over the country. Saw a lot of, all over, the red states where people could build, saw almost
Mhm.
too much new supply come on. And then, the National Association for like RV parks and campgrounds, I think OHI, has this data that they say 70 million people did outdoor hospitality in like 2023. It's down to 50. So the industry peaked again for demand in 2023, but there's that supply chain bullwhip where people are still building parks. If I decide that RV is the best business to be in 2022, I go buy the land, I get it entitled, I start construction, I finish it, I open it. That's a 3-year process. So I'm not even open
Mhm.
till 2025. The market's already peaked and coming down. At the same time, everybody else got the same idea. We see a lot of guys that call us, "Hey, we're building this RV park," and I'm like, "You're going to spend $60,000 a space to build that property, and it's going to be worth 40 when you're done. It's a bad use of capital, bad use of time, in a lot of markets. Again, if you're on the water, if you have a super unique amenity, different story.
Location,
Um,
yeah.
yeah. Yeah, there's some great markets. But I would not want to build an RV park today. If I'm building what the standard is now, concrete pads and amenitize and all, I would look for a market where it was guaranteed to gross at least $8,000 of revenue per space. And I would look for a market real likely it could gross 10,000. So I'm building to like a 10 cap. If I'm not
Yeah.
building to a 10 cap, why am I spending 3 years of my life beating my head against a wall?
Yeah. Yeah.
And I've done it.
Well,
Like I'm in the expansion in Tennessee. I've got one in California, to your point. I bought one after the fires in Paradise.
yeah.
Great basis, but what could go wrong does go wrong with development usually, and and then you add in layers of government, approvals and all. Um, development has got to be well compensated. So I think we really need to hit the brakes on RV development for a while and let the market catch up, let the demand catch up.
Yeah. Are you seeing any development in the manufactured home community space? I mean, what I've heard is there's been like two or three new ones have come out in the last like 2 years.
Yeah, I mean, I think Texas still has got a lot of new product being developed. I mean, I can think of a few developers that are pretty active in Texas, Houston, Austin, Dallas, definitely. A few in Arizona. Scott Roberts continues to build great product in both spaces, MH and RV. And then, we're seeing some rebuilds out in California and Paradise. I'm
Yeah.
up there, so I see a couple of those going on. Um, and Florida, of course, there's a few of them around. I mean, I'd say nationwide, if they've built 50 new parks in the last 3 years, that'd be probably it's on the M8 side, probably 50 is probably the number. It's under 100. Um,
Yeah.
but they're nice sized projects. I mean, there's plenty of 300 to 500 space projects being developed in Texas. So yeah, that little bright spot there. I feel like MH is not one of those things that can get overbuilt, because we just end up participating in the greater housing market, and you
Mhm.
kind of figure out where you need to be on lot rents compared to apartments, and your home prices compared to single families. And if as long as you're bringing a product to market that is roughly half the cost of a single family home, I think it'll move. Um, and you just got to toggle your lot rent to be fair based on real estate taxes and HOA dues of equivalent, community.
Yep. Yeah.
If there was somebody young in it, or young or old in age, but new to this industry
Mhm.
that's interested in mobile home parks or RV parks, what would you say to a new person just getting into this industry? What is a good path that could lead them to success?
You know, the biggest thing that I've learned the hard way is, everything is operations, in my opinion. I mean, you get a great source of capital and buy a bunch of stuff, and then figure out operations later. But if you're lucky enough and or connected enough, and you think you've got a really good wealthy investor that just wants to buy stuff and needs tax write-offs, you can aggregate a big portfolio and make money. But if you want to go out and be a hands-on operator, um, which I think is the majority of people out there, um, you got to buy it right, but you got to get on the ground and you got to work. You got to, figure out what it's going to take to fix those homes that are vacant in the property, figure out what it takes to get those sites filled that are vacant. If you do all that, you'll make money. Find a property with some hair on it. And the beauty of it, again, it's
Uh-oh. I think we lost you, James. Nope, James.
He's frozen on my end.
Yeah, me too. You're back. You're muted, by the way, too. If you,
Muted.
no, you're muted.
there we go. Hey,
But
we had a power outage, like lightning flash. Uh, my monitors go out. I don't know how long it was. You guys were maybe seeing me and I wasn't aware, but I'm on my cell phone now. Are we good?
Yeah.
yeah, we're good. Yeah, we'll edit it out. Whatever.
Okay. Yes. So you were asking, where would you start if you're new to the business? Um, and I think, again, value add. I love the story of, somebody goes in and buys an old rough park and they go in, they renovate those homes. And I'm a big fan of upgrading those homes. If you can, you know, lap side the old homes and remodel them on the inside, take homes that are basically junkers and make them worth 20, 30, $40,000 or 50,000, sell them to the people inside your property, create homeowners, and then fix the roads, fix the place up. You can make a lot of money. I think it's hands on. I think it's a little more operational intensive than people maybe go in thinking. You either have, again, two choices. You either have really really low cost of capital, and you're going to go out and just buy stuff and place money and buy them at 4 and 5 caps for tax benefits and for long term cash flow. Or if you want to move the needle, you're going to have to go out and kind of fix some stuff up and really get your hands dirty. And if you do that and you're good at operations, figure out the operations, you can make plenty of money in this business.
Nice. I know, James, you got a meeting coming up, and so we don't want to hold you much longer. So we do appreciate you coming on the show and sharing your knowledge and your expertise and experience. So we do appreciate that. But before you
Of course.
go, I mean, anything else that you would like to share with the listeners about this industry and you kind of already answered about getting started, but anything else you'd like to share in regards to the industry?
Yeah, look, definitely 5 more minutes or so because I'm supposed to be somewhere at 7, but it's pretty right around the corner, so I should be good. I'm sorry to cut short, especially with the weather fun we just had. But yeah, look, I think it's still a great industry. I think it's and you look at all the other asset classes, our industry keeps on just shining brighter and brighter. It's funny, like you were just alluding to the RV industry. We're definitely a sister industry, and there are times. They're hybrid properties. We sell hybrid properties often. We're just valuing a portfolio of like 1,000 spaces, and 200 of them are RV and 800 of them are mobile. So there's a lot of hybrid, and then there's a lot of RV that functions like mobile home, and then there's RV that's purely RV. But the MHC industry itself is a rock solid, stable business that has never found a predator yet, other than natural disasters, which you have that risk anywhere, and you have to kind of price that in depending on
Mhm.
which coast or which side of the world you're on. Um, it's a great business. My general advice is, if some of these young guys get in and just want to raise rents, add value, build the value of the property, make the community better, and then when the rents, when you turn over homes and when you resell to a new resident, you can demand a higher price for the new person moving in. But be patient with your rent growth. Don't push the rents too hard where you either encourage rent control or get bad regulations passed or destroy your values of your homes. The free market regulates home or lot rents pretty well. If you raise your rents too much, people start giving you back homes and you start getting lower quality tenants, you will end up selling the
Yep.
property for less in the long run because you'll have a lower quality tenant base, you'll have higher expenses, higher vacancy. So, basically charge a fair rent. If you add a lot of value, if you add some new amenities and you make the place nicer, go up on your turnover rents. For instance, if your rents are $500 in a property that you buy and the pool's closed and the clubhouse is ran down and you fixed all that stuff up, maybe you bump the rents 5% a year, 4% a year in your existing residents, but maybe you go right away to 650 in the new people moving in. Because the people living there at $500 a month we're buying those homes under the assumption or premise that the clubhouse was already in crap condition, the pool was already not open. If you fix all those things and add some more amenities, you can attract a better tenant that's willing to pay more money for the house based on all those new amenities. So that's the best program, is to go up to market on turnover, and then with the existing people, just pace yourself. Don't be in a rush. Your lenders are getting smarter about big rent increases. There's a lot of buyers that are getting smarter about it. They don't want to reward bad actors. And then I can tell you, the institutional equity today, if you're looking for investors and you're looking to sign up a major fund to back you to buy more properties, and you've got a bunch of bad articles about you, you'll become somewhat untouchable with the lenders and the equity groups. So
Yeah.
it's kind of fun to see the industry somewhat self-regulate. I'm a big free market capitalist, supporter, but I also think we all got to be patient. Don't try getting rich on any one resident. Just do it over time and add value. And one thing I always point out is your home values will tell you if your rents are low or not. People will tell me all the time, "Oh, my rents are low." Well, what are your homes selling for? If they're selling for way too much relative to their age and the quality, that means your rents are low. If they're not selling for much more than 1 year of lot rent or 2 years of lot rent, and people are handing them back, your rents aren't too low. You got to do something to improve that property before you raise your rents.
Nice. Well said. Very good. Well, James, it's been a pleasure. Appreciate you coming on the show and sharing. Thanks again for changing the time. I know we tried to schedule this last week and we got stuck on a project. So, and then I know you're busy today, so we do appreciate you coming on the show.
No, appreciate you guys having me, and love to catch up again. And we'll hopefully catch up offline soon and get you guys in and out of some deals as well.
All
So
right,
thanks for your
man.
time.
Thanks, James. Appreciate it.
Yeah.
Really
Talk soon.
appreciate
Cheers.
it. Thanks so
Okay,
much.
guys. Good chatting.